Hello, everyone, and welcome to Nonprofit Financials 101, Understanding and Managing Nonprofit Reporting. This is, to me, a really exciting topic, but I know that a lot of individuals probably don't see it as exciting. So I'm hopeful that today we'll get to understand a little bit more about how nonprofit reporting is different and things to keep in mind as you are building your nonprofit or as you are, working through some reporting questions within your organization. A big thank you to the New Haven Free Public Library for the Entrepreneur in Residence program that allows me to bring these presentations to the New Haven community and beyond. All right. This is a proverb that I really enjoy. If charity costs nothing, the world would be full of philanthropists. What is nice is the world is full of philanthropists, even though charity and work in this sector does have a cost. So it's a great proverb, and it's also great to remind ourselves that there is a cost, as we know, to nonprofit work. Hello, my name is Rosalind Zavras. I am the CEO of a small nonprofit advisory company called Europa Consulting. I have over 15 years experience in the nonprofit sector, specifically looking at, how can we scale and how can we grow organizations that want to increase their impact. Our agenda for today is that we're going to talk about some of the building blocks of nonprofit reporting. What does that mean? What are the ways that we need to keep everything organized? We'll do a small dive into nonprofit accounting. I want to be very clear that if you have questions about basics of accounting and what double entry accounting is or any of these terms, there are some really wonderful courses online that go through the basics of accounting. I'm going to really focus on how nonprofit accounting is a little bit different. And then we're going to discuss especially the complexities of nonprofit revenue, because that's really where a lot of these challenges come from. And then I want to leave plenty of time for an open Q&A. So anything that you have questions about that you would like answered, hopefully we'll have good time for that as well. So what are the building blocks of nonprofit financials? Well, first let's think about how are nonprofit financials different? Well, they are focused on accountability as well as financial performance. If you have a for-profit business, your reports are really focused on your performance. How can we discuss all of our activities, all of the items that we're selling or producing, and what is our overall profit margin? Nonprofit reporting, on the other hand, is the emphasis on accountability. Accountability to the donors, accountability to the community, and accountability to the constituents. So that's really the center focal point and something to keep in mind as you are thinking about nonprofit reporting. So how do we do that? How do we focus on accountability? We have to maintain a transparent understanding of a donor's restrictions and how any activity that the nonprofit undertakes, how it relates to the overall mission. So again, keep these things in mind: accountability, transparency of donor restrictions, and how activities relate to the mission of the nonprofit. There are also all of the other concerns that come with financial reporting, right? Performance of certain departments. How are we, what is the longevity of our financial resources? All of those pieces. It's just that these are the layers, and this is the foundation by which nonprofit reporting is built. For the purposes of this presentation, just to let you know the source of my information, it's once on this slide and I'm not going to repeat it again, but it is FASB. It is the presentation of financial statements for nonprofit entities. This is the gold standard. This is by which all nonprofits are supposed to organize their reports. All right, so let's talk about building blocks for revenue, because revenue is really one of the big concerns, right? We have different types of revenue in a nonprofit. We're going to go into greater detail about these 4 types a little bit later, but we have donation. So anybody that, writes a check, that donates to a nonprofit, that's a donation. A grant, say a foundation gives you a grant to perform a particular program or service. There's also donated goods and services, right? So, those in-kind donations of maybe event space, or, like Goodwill, donating all of that furniture. That's donated goods. And then lastly, there's earned revenue. On another session, we were able to talk about and debunk the myth that nonprofits can't earn a profit. They can. The difference is any profit, quote unquote, that a nonprofit earns goes back into the nonprofit. There are no shareholders in a nonprofit structure. The organization receives any positive inflow of money after expenses. So you can, as a nonprofit, you can charge for your services. Many nonprofits do, right? You have a membership to the YMCA. You have a nonprofit soccer league, but you still have dues. There's plenty of ways that you can charge for your services. The thing that nonprofits need to keep in mind is when you are charging, make sure that it is related to your overall mission, so that you don't, cause yourself some headache for tax reporting. But okay, so those are all of the different pieces of our revenue. And within these different pieces of our revenue, not only do we need to classify, is it a donation, is it a grant, is it donated goods or services, etc. We need to state, does it have a restriction? And in simple terms, a donation with restriction is money that is used for a specific purpose, program, or time period. Great example, I'm giving you a donation. I'm really, really passionate about saving animals. So I'm donating my money to the local Humane Society. And I specifically want that money to go towards cat rehabilitation and cat expenses. That is a restricted donation. That means that I've told the local Humane Society, I'm giving you this money, but for this very specific purpose. Conversely, donors can say, it can be for anything you need. I just want to make sure it's used this year because, I know this year's been really hard for post-COVID restarting, so I want the money to be used in 2022. That's when you say it's maybe not a particular program or purpose, but a particular time period. Something to note, if you've been working in the nonprofit sector for a long time, you might be used to talking about temporarily restricted and permanently restricted. If you don't know those words, that's okay. But the IRS has updated its guidance. So now it's tried to simplify revenue, and revenue either has a restriction or it does not. And so if it does not, it is called money without a restriction. There's no specified use from the donor. Let's make sure that this is very clear. The donor is the person stipulating the restriction. Numerous nonprofits will have board designated funds that the board has decided, okay, this money is going to be used for this particular purpose. That is still considered unrestricted money in this setup. It is just designated, right? So that's an internal decision that it has nothing to do with what the IRS and other reporting entities consider as restricted revenue. The restriction comes from the donor and the donor alone. Okay, let's talk about our expenses. So we have, the money coming in, and then we have the money going out. So our money coming out is in a variety of buckets. These are often called categories. The official term is accounts on the chart of accounts, which we'll look at in a moment. But it's ways that you can organize your expenses so that you understand what their purpose is. In the US, reporting to the IRS, there are very specific categories you need to make sure you're using. And the big one is you have to segregate what are personnel expenses, so expenses for people, versus non-personnel expenses, or sometimes what's called other than personnel services, or other than personal services. So you have your personnel, right? That's your salaries, that's your benefits, anything that it costs to have staff. Then you have all your other expenses, right? You have your operating activities, maybe you have marketing, you have your events, you have supplies, you have your IT expenses. All of those are different categories. As the leader of a nonprofit, you can decide what the categories that you use are. But there's really good resources again online for some nonprofit typical, what are called chart of accounts, so that you can see how these expenses are organized. These expenses are then subdivided. And this is really important to understand. This subdivision of expenses has implications for both your tax return as well as other reporting that is often required. And the biggest one is, what is a program expense? You maybe have heard this from board members, from colleagues, or from donors, or even around, this giving season. I want to make sure my money goes directly to the program. What that means is the expenses that they want to make sure their donation is going to the initiatives and activities that the nonprofit undertakes as a part of its mission. So again, using the example of the Humane Society, if any expense related to the care of animals would be considered a program expense. The other designation is management. So these are expenses that are related to the running of the nonprofit, right? We need an accounting system and an accountant. We have rent for our building. We'll talk a little bit about rent more in a second, though. Anything that isn't specifically that you can't say we purchased this for this program, that is considered a management expense. Other words that you might have heard are overhead, or general and administrative. There are lots of different ways to say management. The third designation is fundraising. So these are specifically expenses related to fundraising money for the nonprofit. So that's normally marketing. That's normally, it's also called development in a lot of nonprofits. So, if you have a development person who manages all of your donors, that is considered a fundraising expense. These three buckets are often called the functional expense categories. And they are, again, very important because they relate to reporting that you need to do to the IRS, and they're also just a part of the lexicon of nonprofit reporting. And so we have here the building blocks, or the main categories that we need to be thinking about. What's really important with nonprofit work specifically is that this makes your reporting a little complicated, right? Not only do we have our expense categories that you would see on any financial statement, but you now also have these three subdivisions: program, management, and fundraising. Most nonprofits also have departments. They have multiple programs that they're running. And then there are grants, as we'll talk a little bit about that later. So the challenge that we are thinking through today is, how can we ensure that we're categorizing all of our expenses, all of our revenue, based on all of these different pieces. So let's talk a little bit about program expenses for a second. One of the reasons I'm going to focus on program expenses is because, as I mentioned, this is the holy grail often of nonprofits. You want to maximize program. That's something that is often heard. Or a nonprofit that spends 90% of its expenses on program is a solid nonprofit. Is a myth. We also debunked that in one of our previous sessions, but the idea is programs are related to the direct delivery of your services. However, you still need to run the nonprofit, right? You still need to keep the lights on, and there are other things that might not be directly related to a program, but are very important for the success of a nonprofit. So what are program expenses, right? Those are our staff, the salaries and benefits of staff working on programs. So a question that I've gotten often is, say you have, again, a program team and you're delivering a particular service. Maybe you are delivering meals to local shelters, and that is your service. So everyone that delivers those meals, okay, great, they're program staff. But there's an admin assistant with the program team that helps coordinate logistics between all the various shelters, ensures that there's cars available, does all of the logistics only for the program team. They don't do any logistics for anybody else. That is still considered a program staff. Even though they are the administrative assistant and their title might be admin assistant, they are not an admin cost. They are part of the program expenses because they work directly on the program and supporting the program team. All right, then systems. So any platform or tool that you need to do the program. Again, if you're delivering food and you need a car registration program because you're checking cars in and out so that you can do these deliveries. And no other part of the organization uses that program. That is a program expense. Just because it is a tech tool does not mean that it is not a program expense. So that's why it's really important to think about when we're categorizing our expenses, we have both the type of expense it is, it's an IT expense, but then we also know that it is an IT expense for the program team. Supplies, any materials that you need. Again, just because something is an office supply doesn't mean that it is an admin expense. If it's office supplies that you're purchasing only for this particular need, then it is a program expense. The Humane Society example, if you are purchasing newspaper just to line the crates of, all the animals, then obviously that is a supply just for delivering your program. And lastly, indirect costs. And we're going to talk a little bit more about indirect costs. This can be confusing. Indirect costs are costs that are shared by either multiple programs, multiple departments, or just across the organization. Great example is rent. If you have a building and inside that building you have your program team, but then you also have your administrative team, right? All of your operations folks, and then you have your development or fundraising team. All of those individuals are sharing that particular space. So the way most nonprofits manage this is they will calculate the percentage of that space that is occupied by the program team and apply that percentage to the overall cost. That allows them to say, okay, half of this building is our program staff, so therefore half of the cost of rent, utilities, phone lines, etc., are a part of the program team. And this calculation is typically done at the end of the month or the quarter or the year, like I said, based on some particular designation or structure. So like I said, indirect costs, they are shared by multiple departments or programs. Say you have a printer, everybody uses the printer. That's again a shared cost, the cost of toner, everything. You need to have a schedule. So a schedule in accounting terms is usually just a table or some way that you are designating how you calculated that percentage. Head count is a great way to calculate percentage, and head count just means the number of people that are employed by that particular department or program. So like I said previously, if there's 50 people and 25 of them are a part of the program team, then the program team has 50% of the cost of any of this shared equipment. Please note that not all grants allow for indirect costs to be covered. So it's also really, really important to think about. And when you're applying for grants and you're looking at the requirements for a grant, please review the indirect cost allowances. There are also many grants that don't allow specific expenses. So maybe they don't want you to spend money on travel or something like that. They will also oftentimes have specific rates. You're allowed to cover, this grant maybe only covers 25% of indirect costs, and that is the max. So these are very important to know how much they cost, to have this schedule, like I mentioned, or table of how you are organizing these costs. And then making sure you know, is that allowable by your donors? So let's now dive into some accounting, which I know is a very interesting topic of conversation, but hopefully it will shed some light on any questions you might have. So the chart of accounts in general accounting terms is just your organization of all of the transactions on your financial statements into categories. And within the nonprofit chart of accounts, there are typically these buckets that I'll walk you through. And this is very similar. If you know accounting, this is going to be incredibly similar to a regular chart of account. So the first section of your chart of accounts are your assets. And those are typically numbered in the 1000s, or it could be 10,000s, but they normally start with a 1 and then there's some zeros. Those are your checking accounts, your cash accounts. Maybe you have petty cash, your inventory, your equipment. It's anything that the nonprofit owns or is owed, right? So accounts receivable is money that someone said, I will pay you this amount of money, and you are now owed that amount back. So assets are anything that you own, or are owed. And your liabilities, that's going to be in your 2000s. This is the amount of money that you owe to someone else, right? So maybe it's your credit card balances, it's any payables. So you know, instead of just going to Staples and purchasing office supplies, maybe you have an agreement with Staples that you've opened credit, and at the end of the month, they will send you a bill. That bill is considered a payable, right? And you normally have maybe 10 days to pay any particular invoice. Any loans that you have, as well as any deferred revenue. So deferred revenue is considered a liability because you have promised to deliver a service, but you haven't delivered it yet. So in theory, the person could ask for a refund, right? You either owe them the service or you owe them the money. That is why it's considered a liability, because you owe them something. Once you deliver, they then will owe, right? That becomes just revenue for you. The next category, so this is specific to nonprofits. In a for-profit context, this is called equity, but there's no equity in a nonprofit because, as I mentioned at the start, our equity lives in the organization. There are no shareholders that we need to pay. There's no stocks or dividends. Any profit that we have comes back into the organization year after year. So as we talked about, the donor restriction is what drives the net assets each year. So there's either our net assets with restriction. So that means we have all this money from donors that have been restricted to a particular program and we haven't gotten a chance to deliver on that program yet, or just its net assets without restriction, meaning the donors have given us the money and we can use it as we need. So the important thing about net assets with restriction is that oftentimes you have donors ask, or granting organizations ask, how much do you have by particular fund? And fund just means by particular restriction designation. So say, for instance, I am, again, this humane society, and I have a cat care fund, and then I have a dog care fund. So my earlier donation to ensure that health and well-being of cats goes into this cat fund. And if next year I decide, I really want to support the dogs, my donation would go into the dog fund. That is why nonprofit accounting is sometimes called fund accounting. That is because each of these designations that donors can give is considered a fund. So in order to account for that, it is fund accounting. And then, as we discussed earlier, we have our revenue. So all of the money that we earn either through producing a product or through our donations. And then all of our expenses. So we have all of our expenses that we talked about earlier. All right, so accounting standards. We have two main ways that we can talk about accounting in the nonprofit world, and they are governed by obviously the Internal Revenue Service. And what we have is the generally accepted accounting principles. Those are considered the accounting rules for everybody. Even for-profit businesses are supposed to follow GAAP. That is what it's called. So if you ever hear someone talk about, oh, is this GAAP or not GAAP? They're not talking about minding the gap, from the British subway, but rather generally accepted accounting principles. There's an independent organization called the Federal Standards and Review Board. That's FASB. That is what creates the written standards around both nonprofit reporting as well as general accounting and reporting. The US uses GAAP. Other countries use a different standard. So, if you see other acronyms in the mix, that might be because they are maybe based in another country. There's also the Government Standards and Review Board, and that is for managing government accounting and government reporting. I will say, though, all governments, both federal and state governments and federal entities, they submit their financials through GAAP, meaning they use GAAP as their standard. However, local governments, so maybe a city government, a county government, and school districts have the option to, based on each state, use GAAP or not use GAAP. Connecticut is a fully GAAP compliant state, so all municipalities, all school districts, they will use GAAP. But as you can see in this graph, that it can be a little bit all over the place. And so if you're working with an organization in another state, or especially one that works with a school district or a local municipality, they might not use GAAP. What is the benefits of using GAAP? It is clear. Everybody within the, not everyone, but it is a standard within accounting and finance, both nonprofit and for-profit. So if you want to present your financial statements, and especially if you have individuals on your board that are from a for-profit space, then you will you want to probably present your financials through GAAP, so that it's understood, easily understood by all board members. So within accounting, there's two types also to organize your transactions and reports. And one is GAAP compliant and one is not GAAP compliant, and we'll talk about that a little bit. So the first one is cash basis. Most of us in the world, when we're talking about our own personal finances, think about it from a cash basis. And so that means I think about the money that is in my bank account right now. What do I have in my bank account right now? That is what I consider my overall cash position. It's a very simple accounting method, like I said, that focuses on current cash. So if, for example, somebody promises to pay me in a month, from a cash basis, I don't consider that or even think about it until I receive the cash. And then the converse of that, or the opposite, is accrual. So accrual is GAAP, and it's accounting method that focuses on when revenue and expenses are earned or incurred, but maybe money hasn't changed hands yet, right? So someone has promised they're going to pay me in a month. I consider that on my books as an asset because they owe me the money. And so let's talk about what's some of the differences between cash versus accrual and why might you want to do one or the other. So cash, what is nice about cash-based accounting is that it's a very clear picture of what you have right now. As I mentioned, most of us, when we talk about budgeting our own personal finances, we're thinking about how much is in our bank account right now. And we have some projections of, okay, I know I need to have money for rent, but we're very much what's in and out. This is not GAAP compliant, as I mentioned. So if you want to present GAAP financial statements, they cannot be in cash basis. But it's super easy to prepare financial statements for non-accountants. Like I said, it's just intuitive. So some financial programs, QuickBooks is one of them, will allow you to present your financials in either cash or accrual. So what's nice is you can toggle between the two. And when you do toggle between the two, knowing what that difference is, right? That we're looking at current cash when things are received versus when things are incurred. And again, in that example of Staples, if I went to Staples and I purchased everything on credit, in a cash-based system, those aren't expenses until I actually pay for them. In an accrual system, it is an expense right now, even though I have yet to pay. So let's talk about accrual. So accrual gives a nice picture of current and future cash, as I talked about. It allows you to say, okay, I've earned this revenue, I haven't received it yet, but I have, I know that it is coming, and same with expenses. I indicated that I was going to pay for this widget, but I haven't paid for it yet. Accrual accounting does require typically someone who has very specialized knowledge or an accounting system built on accrual accounting. QuickBooks, which is the most common accounting solution, does accrual, as I mentioned, accrual and can present things in cash basis. All right, so within nonprofit reporting, the financial statements, there are 4 financial statements that are required to present as a part of your package of financial reports. They have different names than their for-profit counterparts. So if you've ever worked in a business and you see some financial reports, and then you look at the nonprofit words, you might not know what are we talking about. So the statement of activities, that is also called in the for-profit world the profit and loss statement or the income statement. And it details the nonprofit's revenue and expenses for a given accounting period. And it then also lets you know how that will affect your net assets. So in for-profit terminology, the statement of activities is similar to your income statement, with the main difference being it lets you know how the net assets will be affected by this activity. Whereas the statement of financial position in the for-profit context, known as the balance sheet, that details our assets, our liabilities, our equity or net assets with donor restrictions. So notice already that the 2 primary reports are heavily focused on restrictions. So that is why it is so important to understand what the donor has stipulated about the money they are giving you. That is the central key to unlocking all of the other parts of your reports. The statement of functional expenses, sometimes also called the report by activity and function, most of the time called statement of functional expenses, but it classifies your expenses specifically by activity and management, fundraising, or program. Remember those three pieces that we had talked about before. This is very important. Like I said, it's a part of your nonprofit tax return. And then finally is the statement of cash flows. This is very similar to the for-profit context. So it is just a understanding of the movement of cash in a given period for your organization. The statement of functional expenses, I forgot to mention, has no analog in the for-profit context. It is very specific to the not-for-profit reporting in the United States because of the emphasis that nonprofits are supposed to be accountable and transparent on how their finances are related to their activities and mission, right? So that program part of the statement of functional expense lets the world know how your finances relate to your mission. Another thing that's really important to note is that the your tax returns are public as a part of the requirements with nonprofits in the United States. So these, when I was talking about transparency and accountability earlier, that's another piece of this, is that these reports, once you submit them to the IRS, they are then, once approved, made public. So you can search for the 990s of any nonprofit in good standing on a variety of different websites. And most nonprofits will also put that on their website as well. They'll have links to their 990s. 990 is the nonprofit tax return. So let's dive into the statement of activities a little bit, and let's make sure we understand how they're organized. So we have two programs. Again, let's continue to use the Humane Society. I have our dogs, dog care, and then our cat care, right? So we have certain revenue that's restricted to this particular program. And then we have expenses that are related to that program. In this example, notice how the expenses are greater than our revenue. So then that means that we have satisfied all of the requirements of that revenue, and therefore it is now considered released. What does released mean? When revenue is restricted by a donor, it means it's restricted. I like to think about it as in a little pen. You know, it's walled off right now and it can't be used until we satisfy the restriction. And when we satisfy the restriction, we can release that money from its box into the rest of the organization. And so again, if I say I'm donating $100 for cat care and you spend $200 in cat care this month, you've satisfied my restriction, right? You've more expenses than the amount that I donated. So my $100 is now no longer restricted, right? Because it has been used. Whereas for program B, we have a lot more revenue than we have expenses. So that calculation of revenue minus expenses means that we still have some restricted revenue left. You know, maybe we just don't have as many dogs right now. So we've gotten this huge push for donations for dogs, but we don't have that many in the kennel. So that means that we have released revenue from program A, meaning we've satisfied all of the restrictions and it's released. Then we have restricted revenue, net from program B. And net just means revenue minus expenses. Now, say you just have general unrestricted revenue. That's the third bucket. That's just considered unrestricted revenue. You don't release it because it's already in the general pot for use. And so, you have your fundraising expenses, your management expenses. So say we're very lucky that we have all of this extra revenue that isn't restricted, and very few expenses. So that is how our revenue and expenses are organized. And now we need to think about the statement of activities itself. And the statement of activities is subdivided into restricted and unrestricted. That's it. There are no restricted expenses. I'm going to say this again. There are no restricted expenses. There's only restricted revenue. That is simply because the revenue is restricted because of the donor. The donor doesn't restrict your expenses, right? The restriction has nothing to do with the expenses. It has only something to do with the donations from the donor. Your expenses that are related to a program are simply related to that program. Like in this case, we have expenses related to program A, we have expenses related to program B, and then we have general expenses. In the statement of activities, all of those expenses are all considered unrestricted. And so how do we then get the restricted part of our statement of activities? It has revenue. It has this year's, TY is this year's revenue plus last year's unreleased revenue, right? So when we talk about our released revenue, that now lives on the released revenue part of our unrestricted statement of activities, because it is now, as I mentioned, the box around the revenue has been taken away and is now in the general pool for use. And our restricted revenue, that is still restricted because our overall expenses are less than the revenue for this particular program. That net revenue is what lives as restricted revenue. And so our unrestricted is all of our expenses and our final revenue minus expenses. And these last two add to our, as I mentioned, to the change in net assets by restriction, right? So in this example, we have from program B, we have unrestricted revenue, or we have restricted revenue that is still needs to be saved for next year. Because as I mentioned, we got all these wonderful donations for these dogs, but we don't have many dogs in the kennel right now. So we need to save this money until next year, when maybe next year we'll get a bunch of dogs in and then we can use that money. That is the whole point of the statement of activities, is it's trying to let you know what you need to save for future use and what you don't need to save because you have used that money right now. All right, so that's the statement of activities. The statement of financial position. Now, remember, if you know a little bit about accounting, all of these reports have to balance. They all connect to each other. And so I like to think about the balance sheet and the statement of activity or the statement of financial position and the statement of activity as two puzzle pieces, right? And you put those puzzle pieces together, and that gives you the full picture of your accounting within a nonprofit context. So assets, as I mentioned, are everything you own, and everything that is owed to you. Liabilities is everything you owe. And then you have your net assets. So our net assets with restrictions and our net assets without restrictions. That's your statement of financial position. There's more detail in it, right? How much is in your banks versus how much do you have in cash? How much do you have in inventory on hand? But the simple way to think about it is, what is everything we own, physical and financial? And so as we talked about before, that with restrictions, so the balance of restricted revenue, so that's revenue that we need to save because we haven't gotten a chance to use it yet, that moves and is considered a net asset with restriction. This is the way that we ensure year to year that we know how much we're saving for future use. And then net assets without restriction, that just means everything over the past year that we earned minus all of our expenses, right? Everything that we earned that was either open and unrestricted, or anything that we have released from restriction, like in the previous example. Now, these are very, complicated, obviously, to piece together. Most financial packages will, like QuickBooks or any other system, organizes these financial statements for you. The point here is to understand what they say, what they mean, and in the nonprofit context, things you need to keep in mind. And if you remember nothing else, please remember that your donor sets the restriction, and you need to understand what the restriction is and how you can satisfy it. And so our assets minus our liabilities equal our net assets, or the assets is equal to everything that you owe plus all of your net assets. Now, the statement of functional expenses, after all of that complication, I think a little easier to understand, because it's just, as I mentioned, all of your expenses based on what programs and management and fundraising that you have experienced or you've used in the past year. This is just a yearly report or a monthly report that looks at, okay, so we spent this amount of money on program A, B, and C. We spent this amount on management and this amount on fundraising. Our statement of cash flow, again, remember that this is a very typical report that exists in both a for-profit and nonprofit context. So if you're using an accounting system, this will be put together for you instantly. It is the movement of cash in and out. That's all you have to think about it. And it's broken up into 3 sections. Our sources of cash, right? So where is our cash held? Bank, account, investments, etc. How are we using the cash? So this is our outflow, right? We spent money on expenses or investments, and then the overall change in your cash balance. And when we're thinking about changes in cash, we're thinking about it from operating activities, investing activities, and financing activities. And that makes sense. When we think about even our own personal finances, we're thinking about, okay, operating activities, right? What money came in, from our salary, what money came out for our expenses. Investing, maybe we are investing in our retirement accounts, or we have a savings account, right? That it's still cash that we hold, but it's in a different spot, right? And it has a different use. And then financing, right? Do we have any loans? Do we have a car note? Do we have a mortgage? Those are all really important to know, because again, that is where our cash is tied up. And so it's the same with a nonprofit and any business, right? We want to know where all of our cash is, how it's changing, and how we're using it. So those are the financial statements. As I mentioned, those 4 financial statements are the building blocks, or the key required financial statements that every nonprofit is supposed to produce. Any nonprofit board will be looking for those 4 reports, as well as your auditors, or any grantor is normally looking for those 4 reports as well. They are also a part of your nonprofit tax return. And since revenue is the key part of all of this that causes so much confusion, I'm going to spend the last few minutes of my presentation really diving into the different sources of revenue. And then, like I said, I'm going to open it up for any and all questions that you have. So nonprofit revenue Let's a quick summary of the slide from before, right? We have 4 buckets in revenue, and we have with restriction and without restriction. Remember, you have both the category of your revenue, which is donations, grants, donated services, or earned revenue, but then you need to know, is it with or without donor restriction? So let's talk about donations. These are contributions by individuals, corporations, or foundations. They can be, a company can donate money, a person can donate money, another organization can donate money. The sort of technical way that you can describe it is a voluntary transfer of assets in which the donor receives no benefit. There's a small footnote on that, but let's think about what that means. That means I am giving you money and I am not receiving a service for it. Normally when we go to Target to, buy something, what we're doing is we're giving the store money in exchange for a good or service. With a nonprofit, we give money. Granted, you can say that you receive a lot back because you know that you're making the world a better place or helping a particular cause that you're really excited about, but you are not the person receiving that benefit or receiving that service. So that is why it is a donation or a contribution to the work of the organization. Now, sometimes when you're doing a donation, like right now, I know NPR is in the middle of its fall fundraising drive. You give a donation and then you get something in return. It may be, an NPR mug or, some sort of gift for the donation. That is still considered a donation, but you have to remember that anything you received takes out of the actual tax deductible portion of it, and we'll talk about that in a moment. So donations can be in the form of cash, right? It doesn't have to necessarily be, that can be cash, check, credit card. Your method of payment is irrelevant, but you can donate cash, you can donate stocks, you can also donate in a bequest for, in your will, and anything like that. So I want to also, though, emphasize that there's a subtype of donations called pledges. And a pledge is a promise to give or a promise to donate, but at a later date. So say I, instead of writing a check for $100, I'm telling my local Humane Society, I'm going to give you $1,000 over the next year. I'm just not writing the check for $1,000 right now. That is a pledge. That is a commitment to give. So let's talk about pledges versus cash for a moment, because that's really important to note. So pledges are placed on financial statements for accrual systems, right? So that's what we were talking about, cash basis versus accrual earlier. Pledges are not going to show up on a cash basis of financial reporting because we don't have the cash yet, right? So cash basis is focused on when we have received the money, not when we think we're going to. So if you are doing GAAP-based financial statements, then you would have pledges on them. It must be a binding commitment in some way. Typically, the way a lot of organizations do this is either have the donor sign something that says I'm pledging this amount of money, or if a donor pledges over the phone, the organization will respond back with an email saying you are confirming that you are donating, $1,000 for this particular reason. In GAAP-based accounting, you must record the revenue when it is pledged. So a lot of organizations that I've worked with find this a little surprising because then it blows up their revenue for one particular time of the year. Right now we're in the middle of giving season. In November, especially with Giving Tuesday, that is a time when individuals become really generous and really open up their hearts and wallets to wonderful organizations. That means in the months of November and December especially, your financial statements will be very skewed. You'll have all of this revenue, right? Even though maybe you don't receive the revenue until sometime next year. That is why, again, if you're using a financial system or a bookkeeping system that is able to toggle between cash and accrual, it can be really helpful. So you can say, okay, well, we received all these pledges, but we haven't received the cash yet. And a pledge can be long-term or short-term. I've had numerous examples of donors saying, okay, I'm going to give you $1,000 a year for the next 10 years. That is a long-term pledge. And so it's a pledge of $10,000, but each year you will discount that pledge. Your accountants will discount that pledge because the value of the dollar changes year after year. So pledges are great. They're a wonderful way to bring in money for your nonprofit and really focused on the future. But like I said, they do have to be recorded as revenue in a specific way, and you do need to make sure that you're capturing that pledge somewhere. Whereas a cash donation is more instantaneous. You record the revenue and the cash at the same time. There's no promise of future payment. It is simply, this is a payment I'm giving you right now. Note that if someone's giving you a cash donation, you can record this in both accrual or cash-based accounting. It is simply a record of cash and revenue at the same time. And as I mentioned before, payment method is irrelevant. It's called a cash donation even if they're giving you a check or paying by credit card. So let's talk about fundraising events a little bit. Again, we're still in the donation bucket. So one donation is considered, can be very complex, and a lot of nonprofits in their chart of accounts will differentiate contributions versus event donations versus cash donations, and pledges. They will separate those out. So you have a fundraising event, you sell a ticket. Well, that ticket costs money. That event costs money, right? There's the event menu, there's refreshments or food, there's the entertainment for the event. That is considered a direct donor cost. All of those costs to put on that particular event are considered direct donor costs, and those actually are supposed to be on their own on your financial statements. And so when you have a ticket, so say you charge a ticket for $150. But all of those direct donor costs are $100 divided up, right? Then the $50 that is in excess is your contribution. And that is what's recorded as revenue, is just that $50, not the full $150. And so just remember that the full cost of a ticket is not considered a donation. The only part that is a donation is the amount minus of the ticket minus the cost of the event. So you could say, well, what if I have an event where the costs equal the ticket? Well, that can happen, and maybe the point of the event was to raise awareness and not necessarily to raise funds, and that's okay. I would just, within nonprofit leadership, I would have a conversation of how many of those events can we sustain, and do we want to keep giving events at that price if it's not covering or barely covering our costs. At events, there's typically auctions or raffles or anything like that. Or like I said in the example of NPR, I donate money and I get a mug. Any amount that the donor is donating is considered a donation. However, for the donor itself, only a portion of that donation is tax deductible. So remember that if somebody donates money, but then gets, they win a trip to Paris and they only donated $500, the chances that the value of that trip to Paris is less than $500 is not very high. So technically that donation for the donor is not tax deductible because they received a gift that had a greater value than their donation. So remember, the total amount that they spent is considered a donation for you, but for them, the tax deduction is only the difference between the amount that they spent and the fair market value of the item. So it is really important when you're planning events to calculate the fair market value of everything. What is the value of the refreshments, of the venue? You know, all of these costs are very important to calculate so that you can organize your statements and your receipts to your donors appropriately. Okay, so that's contribution. Let's touch briefly on grants. So grants are considered payments to nonprofits for specific services by a third party, right? So that could be a foundation, that could be a variety of individuals that are giving you money for a very specific program or service that they want you to perform. So as I mentioned, they can be given by governments, private foundations, corporate entities, individuals. And they're typically a contract for services, right? There's usually a grant agreement that is signed between the grantor and the grantee. Generally, grants require insurance and other compliance documents. So maybe the federal government is big on this. They often require an audit. Even if you don't hit the audit threshold of your state, which in Connecticut is $500,000 in revenue, you could get a grant, and even if you earn less than $500,000 in revenue, they still would require an independent audit. They also oftentimes have large insurance requirements. So again, these are things to think through. If you're going for a grant, what are their requirements, and does that make sense for your organization, right? If it's a $10,000 grant, but then they're requiring for you to have an independent audit will cost more than that. And oftentimes the grants are requiring something that they might not fund. So please, when you're looking at grants and when you're thinking about grants, look at their requirements because it might not be worth it, even though it seems like a really good idea. And they also have separate reporting requirements. So all of that reporting that we just reviewed, you know, everything that we just learned about with the 4 financial statements and how everything's organized, a lot of funders have completely different formats. And so not only do you have to do all that work to prepare your financial statements, those 4 financial statements, you then now have to prepare financial statements in the way that this particular funder wants you to prepare them. Grants can be a wonderful strategy for nonprofits, but just I always emphasize, go into, you know, a grant application with eyes wide open because they can be very complicated. The most complex grants that you're going to go for will be your government grants. And so definitely if you see a government grant that you're excited about that is funding in your neighborhood, in the program area or programmatic area that you're working in, amazing. Oftentimes these grants are large and they're very comprehensive in their support, but they are very difficult to manage. From a financial statements perspective, they are typically considered a payment for services. So because of that, they're not restricted. They are either a prepayment for services you have yet to render, or they are a payment after you've delivered services to the community, right? So a great example would be, again, a food bank. So say a food bank gets a large government grant. Their services that they're supposed to be performing as a part of that grant is delivering food within the community. Well, when they receive the disbursements from that grant, because they are already doing those activities, it's not considered restricted revenue. It's considered almost a payment for food services within that particular community. The government gives a lot of grants because oftentimes civil society or the civil sector is a lot better equipped to deliver services than large government organizations. So these are a great source of revenue, but they, as I mentioned, can be very complex to manage. They have normally their own chart of accounts that they require you to report in, and they normally also have set rates for, or maximums for payroll, for contractors, for indirect rates, and things like that. So just keep that in mind, again, if you go for a government grant. Private grants, on the other hand, can run the gamut, right? Because they can be corporations, they can be individuals or foundations, family foundations, large foundations. So each entity manages their grant program separately. Just because you got a grant from one family foundation doesn't mean another family foundation is going to run their grant program the same way. So every time you apply for a new grant with a new funder, talk to other organizations that have received those grants, review their websites, review all of the information that they have available, because they will hopefully stipulate what their specific reporting and compliance requirements are. Also, a lot of foundations don't have what are called unsolicited grant programs, and an unsolicited grant is a open call. Say I give grants, and on my website I have a apply now button. That is considered an unsolicited grant. You just found the foundation, you applied for the grant. A lot of foundations will invite you to apply for a grant if you meet their requirements. And the requirements are usually because they have funding priorities and services that they want to see in a particular community or in a particular area. So just remember that, again, grants are wonderful, but if it's a private grant, then your program needs to align with the priorities that they have. And normally private grants, again, this isn't everybody because each entity manages things separately, but typically private foundations, their revenue is restricted because they're giving you a full disbursement at once, and then you can release from restriction as you are delivering your programs. So just a little bit more, and then we'll open it up for questions. We have donated goods and services. This is also called an in-kind donation. So it's a donation of services or goods instead of cash. So all in-kind donations have to be listed as a separate line on your financial statements. This was in the updated FASB guidance from a few years ago, that instead of lumping in-kind donations in with regular donations, they just want it to be its own separate line so that it's clear. Now, an in-kind donation is both expense and income. And that can seem a little counterintuitive because it's a donation. We have no expense. Well, the idea is that if I'm an accountant, right, and I normally charge $200 an hour for my services, but I'm donating my services each month to do your books and your bookkeeping. So instead of charging you $2,000 for these services, I'm donating it. Well, if I had not donated my services, you would need to find an accountant, right? That's a service that you would need to still pay for. So the idea is that you record $2,000 as a donation or as revenue, and then $2,000 as an expense, and the expense is accounting expense. The same goes if you're given an asset. So nonprofits are often donated cars or land or, anything around that nature. Those are considered assets, right? Now you have its inventory that you own. So that is recorded as an asset, and now as a part of your inventory, as well as revenue of an in-kind donation of a gift. Note that although in-kind donations and services are listed on your financial statements, the IRS only cares about in-kind goods. Those must be on your financial statements. In-kind services do not necessarily have to be, but they should be recorded for especially high-level services, like I said, like an accountant. so that you can, from a financial perspective, know when you might need to pay for services in the future. So a note about volunteers, right? Volunteers are the lifeline of the nonprofit world. They are key to the success of all nonprofits, in my personal opinion. So how do we account for volunteer services? Love your volunteers, appreciate your volunteers, write down how much time your volunteers are donating. Those are important things to know, especially if you have a volunteer board or volunteer, service delivery support. Make sure you write it down. How much are they contributing? And note, as I mentioned, any high skill services that are donated should be considered an in-kind donation. This is because, again, it's really important from a financial management perspective that you know how much this costs in the event that the donation is no longer there and you need to continue to use that service. So last but not least, earned revenue. So earned revenue is, as I mentioned earlier, the process to charge for goods or services. So, maybe you run a nonprofit fitness club and it's the membership each month. Maybe, you're a humane society and you charge an adoption fee. This is all considered earned revenue. Earned revenue is unrestricted. It is not restricted to anything, even though you are charging for a particular service, it is not restricted because it is an exchange, right? Like you have, just as my example with Target, I went to Target to buy some detergent. I gave Target my money, I got detergent. Same with earned revenue. I paid money to adopt this cat, I now have a cat, right? There's no restriction involved. The donor is not placing a restriction on the revenue because it is an exchange for goods and services. And just remember that the revenue is considered revenue once you have delivered the service. So if, for instance, you charge for an entire year of membership up front to your nonprofit fitness club, not all of that revenue is considered, revenue right now. It's considered deferred revenue because you owe that person 12 months of membership to your gym, even if they've paid you right now. So just remember that, if there is an exchange of goods and services, but the services are in the future, that is what's considered deferred revenue. If someone's giving you money for a donation, right, they aren't receiving anything, they are donating money to you, and it is for a particular program in the future, that is considered restricted revenue. So that's a lot of information. I know I would love to take your questions. Please connect with the public library and with Aropa Consulting if you have other questions that come up outside of this conversation. I have office hours twice a week, every week. They are virtual as on Tuesdays and then in person at the libraries, normally at the library on Wednesday. So if you have other questions, please sign up for office hours. I'd love to walk through any reporting needs you have then. But I will, if you raise your hand, I am happy to then allow you to talk if you have any questions. Wonderful, Mary, I will. Okay, now if you can unmute and you can ask your question.
Hi, I just wondered if I might be able to bring in a copy of our 990 and have you review it for things that we could do. Because we do have an accountant, but all he does is the tax return. He doesn't do any bookkeeping for us. And until watching this, I didn't know that I should be listing the volunteer attorney's time as in-kind contributions.
Yes, I'd be happy to. So if you want to bring your 990 in for one of our office hour appointments, that would be great. And I'm glad you learned something new then.
Thank you.
You're welcome. Are there any other questions? Like I said, if you have a question and you think, oh, it's specific to our organization, it's probably a question someone else has struggled with. So happy to talk about it here, or if you want to also, as I mentioned, connect with me during my office hours, very happy to do that. And I am happy to provide my contact information as well. And the office hours, just to make sure that that's clear, is through the New Haven Public Library. So I will type out the answer for everyone to see. But the free office hours are a great resource, and it's a part of the New Haven Public Library's Entrepreneurship in Residence program. So thank you very much to the library for creating this space and having these programs. Great questions, Catherine. So I've typed in the chat. Hopefully everyone can see the link to book office hours through the New Haven Public Library, and also my email if you have any other questions or want to connect outside of that. If you know also anyone in your community, this obviously has been recorded. So please, we are posting it to Facebook Live right now. That will be available as soon as the session's over. And then we will also be putting this up on YouTube. YouTube takes a little bit longer. So, if you want to review this recording again or send it to any of your colleagues or friends, please check up on Facebook Live when we sign off. I am actually going to jump over and make sure there's no questions. It doesn't look like there are any questions right now on Facebook. So unless there are any other burning questions with everyone here, I will say thank you very much for attending. And please reach out to myself or book some office hours if you have any additional questions and want to work through something. My next session will be on nonprofit compliance. So we are going to be looking at audits and other compliance issues in a week and a half. So October 20th, we will be having a session. Again, it'll be both virtual or in person at the library around the web of nonprofit compliance.
And thank you, Roz, so much for putting on this webinar. It was full of wonderful information. I'm sure we all learned a lot.
Well, I hope so. And so I'm not sure how to stop the Facebook stream.
I can do that.
Okay. Wonderful.